Hey everyone, welcome back to another Meet Kevin report. We're on episode 106 today. And of course, today is the day after the Federal Reserve gave us the good old rugging, which unfortunately, even though all of the data was pointing to, hey, you know what? Maybe we're on the right path with inflation, they still had to do the dirty talk. They still had to give us the dirty, and the market is still buying the dirty because, after all, oh, that summary of economic projections did say 5.6%, which now the market is like, does that after all mean we have to price in two more rate hikes? Well, we'll see. This morning, we'll talk about what Richard Clarida said of the Federal Reserve. And did he throw cold water on the idea of two rate hikes, or did he reiterate the idea of two more rate hikes? We'll talk about that. And we'll talk about a lot more as well. But first, let's take a quick look at what some of the futures are doing. We've got, at the moment, the 5-year break even, which is sort of our market's expectation of inflation, sitting at 2.18%. We did get a little bit more of an inversion of the yield curve, which is interesting because even though it seems like the Fed should be closer to the end than the beginning, bond yields continue to rise. You've got 3.827 on the 10-year, and the 2-year moved up. That's about 2.9 basis points, and the 2 years up 3.5. So tiny little bit more of an inversion. Anytime you hear that 2-year moving up more than the 10-year, you're actually going deeper into an inverted yield curve. If you subtract the two now, you're sitting about, let's see here, if we go 474 rather, and we subtract that yield from about 3.83, we're sitting at about a 91 basis point inversion. During the banking crisis, that fell as low as about 50 basis points, and people were thinking, "That's it. Here's the re-steepening of the yield curve," which is a sign that the worst is over, but is usually painful. Usually, the steepening is painful. Nope, we're right back to inversion. So, not fantastic, but shows a little bit of that disconnect between market expectations and summary of economic projections from the Fed. In addition to this, we also have, let's see here, we've got the 5-year break even. We could also look at the world interest rate probability chart. We'll pull that up in just a moment. And the Fed rate futures monitor, just to see what the market's pricing in this morning, especially since you do have indices red, Dow down 23 points, 23 bips, the S&P down 41, the Nasdaq down 71. Some of this may also just be seen as a give back for the pretty euphoric rallying that we've had over the last few weeks. But if you look at July, you're looking at about a 72% chance right now of at least a 25 basis point hike. And then by September, you're looking at a combined approximately 77% chance of at least one hike, with about a 13% chance of a double hike. That would be a July hike and a September hike. So we'll see, obviously, how that evolves as well. Today, I'd also like to go through some short interest, and so we'll pull up some apps to get through some of the S3 portals to get into short interest and kind of see how that's evolving. So we'll do that a little later on. And then let's go ahead and see if we can get the world interest rate probability and then talk about what Clarita is up to. Yes. Okay, that we have now. All right. So I'll pull this up as well as Richard Clarita's statements this morning, and we'll jump into a little bit more on the Fed here. Stand by for Clarita. All right, here it is. Okay. All right, so after that hawkish two-rate SEP yesterday from the Federal Reserve, basically the document suggesting we're going to see two more rate hikes, which Jerome Powell did distance himself from, which we suspected. We suspected there was a chance Jerome Powell would distance himself from a 5.6 on the SEP. He kind of gave this response of, well, you know how it is. People sit around the country in their offices and they send in their projections, and we got 5.6, is essentially what he said. It felt like he was really trying to distance himself from the hawkishness of that summary. Of course, the market is still looking at that, and As we expected, mainstream media is going to talk up like crazy the idea that that's it. Powell indicates at least two more rate hikes ahead after a pause. That's literally the front page of Bloomberg right now. Powell indicates at least two more rate hikes. No, he didn't. Like at no point did he personally indicate two more rate hikes at least. In other words, maybe even three more rate hikes. No, like the hawkish was some of the most hawkish people on the FOMC indicated maybe getting close to 6%, but those were far and few between in terms of the dots. But whatever, they've got to have their headlines, I suppose. So when we actually get a little bit more detail and we look at what the vice president of the Federal Reserve now indicates, Richard Clarida, we have a pretty interesting breakdown here where we get Clarida saying the following quote, I do think that if data is closer to market expectations versus Fed expectations, that could be done in July. In other words, we either have an alignment with confirming the pause or confirming one more hike and being done by July. He says that, quote, I really think that for the first time in a long time, the Fed is data dependent, which is weird because we've literally heard them say that phrase for, I feel like, years. So it kind of makes me think, were you lying about being data dependent then, or are you lying about being data dependent now? Like, I'm not quite sure about that one. But anyway, Clarita did speak after yesterday's meeting, so it's pretty fresh. He says, "quote Given what we saw yesterday, we'll probably get that rate hike in the July meeting, and the Fed has inflation coming down more slowly than a lot of folks in the Fed are expecting." As well as that slower rise in unemployment, giving them potentially more latitude to raise rates one more time in July. However, with only one more labor report and one more CPI report before the next decision, the Fed won't have much more data to go on, says Clarita. It was what I would call an awkward but hawkish pause, he says. Yeah, it is a little awkward, and that's true. And this is actually kind of why I've been thinking, why wouldn't the Fed just wait until September? Because then you would have not only the June data, but the July data, and also the August data, since the September meeting isn't until the end of September. So you're really getting 3 solid months of data if you wait until September. But hey, we don't run the Fed, so we can only speculate. Let's go take a look at what markets are now writing in the world interest rate probabilities chart. And so if we pull that up right now, we get this item here. This is what the world interest rate probability looks like right now. And what we're finding is that markets seem to have really pushed up the July and September bar charts just a little bit here. Let's see. Oh, I cut off the dates over here. Oopsies. But this right here is your September marker right here. And then this is the July marker. So July shows us at about a 5.3. Right now, we're sitting somewhere between 5 and 5.25. So we're in this range. This large range is actually where we sit with rates right now. And so you can see the market is really pricing in that we're going to stay within that range broadly for the rest of the year. And the way you want to do that is you look at what's the midpoint, right? So you look at the midpoint here, about the 5.15-ish, 5.125 over here. And we're clearly well above that. So we're looking at least being at 5 to 5.25 with certainty by the end of the year, no cuts. However, there is this pricing in of potentially a rate hike here in July, but almost certainly one by September. That is, though it's not as fully priced in as you would expect. The midpoint would be somewhere around. Let's see, if you had a new rate range of, let's write this down together here. So if the new rate range would be somewhere between 5.25 to 5.5, the midpoint of that would be 5.375 would be the midpoint. And what you can see is we're kind of off of that midpoint right here. We're about 5.3. So we're a little bit more on the dovish side of that 5.375 where we need to be to really confirm that rate hike with the market by July. So the market is not 100% convinced yet, despite the fact that it seems like the mainstream media wants to be convinced. Let's take a look as well, just in fairness, at the rest of the article. So that way we can make sure we're not just title reading, but we actually have the insight of what the article suggests. So let's go to that. And so this is that piece here. And again, worth noting, it says Powell indicates at least two more rate hikes after ahead after pause. I did not see that anywhere, mind you. Powell sounded relatively dovish. Powell almost implied that he was done and almost seemed frustrated that the SEP came in high with his distancing of this. But I don't think anywhere we indicated at least two more rate hikes. But okay, either way, we'll see what they say here. So Powell, speaking to reporters in a press conference, faced the challenging task of explaining two possibly contradictory policies, deciding to leave rates unchanged following 10 straight hikes, while also indicating that at least two more increases might be necessary this year. I mean, the SEP did indicate that, I suppose, in fairness, that two increases were presented by the SEP. But I suppose the idea of at least two more, and then Powell suggesting that, seems a little misaligned. It was the summary of economic projections that indicated that, not Powell. The committee thought overall it was appropriate to moderate pace, if only slightly. Right. Well, this is in his statement. Okay. Yet, surprisingly high projections may also reflect a return to the Fed's strategy of cooling a resilient economy. It's true, we did see GDP revised up in terms of the forecast. Officials began moderating. Okay, I'm not seeing anything particularly unique in this. There's that 5.6. There's the crux of your article here. Bond traders wiped out bets that the Fed will cut this year, but they had already done that. That this article implies this is news. Before the Fed meeting, the bond market had already removed expectations that we were going to see cuts this year. That was really seen more during the banking crisis. We went through that yesterday, and we saw the banking crisis did indicate up to 170 basis points of cuts, but it's not something that we saw at all going into this meeting. It was already priced out. So it's a little odd. The timing of how they're phrasing this or puzzling this article together is a little frustrating. Powell suggested policymakers want to keep their options open. That's fine. See, that's fair. We interpret this dot plot as a job voting tool, a way for the Fed to preempt further easing in financial conditions. This is some other economist. Well, maybe, but why J. Powell distanced himself from it then is quite interesting. Powell tried to square the pause with a much higher dot to some success. And again, I think it's worth remembering that we expected to some extent hawkishness to talk the market down to justify a pause. It's something we've been talking about for a few weeks, this idea that, all right, well, if we do get the pause, which we expect we're going to get, then maybe they need to be careful not to induce a market rally more so than we've already seen, given that that would suggest, oh, well, the Fed's definitely done then. How can they signal that they're not done yet? Oh, yeah, just send in a bunch of high projections. I mean, who knows? But it seems a little misaligned with this idea that, oh yeah, Powell's definitely signaling two more hikes. Who knows? I suppose. But as a result, the bond market, I personally haven't seen move terribly much, other than a slight increase in the inversion of the twos and tens. In fact, let's look at how much more of an inversion we have. That'll give us a little bit of a tell of how much the bond market actually moved. So yesterday we went from, okay, so we moved about 8 basis points further into inversion. I'll show you how that looks on the chart. And then you can get an idea of this as well. So the inverted yield curve, again, it became pretty inverted before the banking crisis, started steepening during the banking crisis, and then has now, let's see here, let's get this, hold on one sec, window, here it is, has now re-inverted a bit. Take a look at this here on the bottom right. What you can see is the inverted yield curve has shown a drop of another about 8 basis points right here from the meeting. And this brings us to about 92 bips of inversion. We were down here at under 100 for a moment. Excuse me. Right before the banking crisis. When the banking crisis occurred is actually when markets started pricing in, oh no, the Fed has gone too far. The Fed's broken something. And we got this almost immediate steepening of the yield curve. And this steepening is usually deemed to be the painful portion. Of course, as as the banking crisis has sort of unwound, the stock market has basically just done straight up during this. Meanwhile, we've been expecting more volatility. We've been expecting more of a volatile Nike swoosh, but we haven't seen that. We've only seen this straight upness. So it's possible that today in the stock market, we're just going to see some of that give back that to some extent maybe is justified, given that we have been in sort of rally mode for a bit. But I think the best tell will be how the day evolves today, as well as the retail sales data we get, given that a lot of the data that's been coming in has been coming in on the low side, so on the good side from the Fed's point of view. However, retail sales today could be an indicator that maybe the Fed does have more work to do. We did have this morning Chinese retail sales come in. Chinese retail sales did come in a little soft, and that's sort of reiterating this fear that China's going through an L-shaped recovery. China's retail sales grew by 12.7% last month, and that was a miss. 12.7%. When I first saw the number, I'm like, oh, that seems like a lot, but no, it was actually a miss. And apparently, youth unemployment hit 21%, a record high. And now there's even more talk about China having to support its economy to avoid a more severe economic recession, potentially. Although I think the odds of China going into a recession are not likely. Maybe the way to put it would be slowdown, slowdown from growth, and that they're going to miss their 5% GDP target, especially after New Zealand entered its recession officially yesterday. GDP contracting 0.1% in the first quarter, and that's now marking 2 quarters in a row of a negative GDP growth for NZ, which follows Germany. If you look at the NZ50 stock price, that's the New Zealand 50. You actually find that even though they're in technically recession now, you look at the year to date, and the chart is down slightly. You're down at about 11. Actually, no, you might be about roughly even now. Yeah, you started the year at 11,632 on it. And you're sitting at about 11,687 now. So you're roughly flat on the year to date. You're up on the 1 year. You're up on the 5 year. But if you purposely try to look for a peak, you're still down about 12% from the peak on the New Zealand Stock Exchange. So a little bit of that recessionary pain, I suppose you could say, being sitting in that NZ market. But boy, it's really these economies that are actually going into recession. Their stock markets are not looking scary at all. So who knows? Now, another comment that I actually think is very reasonable that I see here in the chat, and thank you for this, is Jay Santiago makes a very good point. The 5.6% from the SEP came in Friday. That is true. Jerome Powell did say that. He said people sit across the country in their offices and they sent the data in Friday, and that's what we gave. Well, if the data came in Friday, that means the summary of economic projections was actually formed before we got PPI and CPI data. Maybe that's why Jerome Powell during the conference was so frustrated about that summary of economic projections. Maybe that's why immediately afterwards you have Clarita throwing soft water on the idea, or cold water rather, on the idea of 2 more rate hikes coming. Rather, Clarita suggesting, no, 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 it's probably just 1 more rate hike. Really interesting. So this is a very good point, Jay Santiago. I appreciate that. And it sort of reiterates Clarita coming out the very next day after the FOMC meeting, suggesting, yeah, no, 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 that SEP is basically a little high. Of course, the mainstream media is going to run with it because it's a fun and scary headline. Oh, 2 more rate hikes priced in. I was reading articles yesterday on the Wall Street Journal, and they're like, oh, well, what if we have to go to 6%? This is the new reality for the Fed. They're going to go to 6%. And I'm like, on what basis? Jeez, Lord. But whatever. That's just what you get, I suppose, sometimes from the good old MSM. So we'll have to fight through some of the market bearishness over the next few days. I would expect that there will be a lot of people who see this as an opportunity to buy the dip, especially since there's a substantial mispositioning. Although it could also be an opportunity to rebalance portfolios, given that stocks have run a lot it could make sense for people and individuals or companies or funds to do a little bit of rebalancing and try to rejigger to where they want to be for the market going forward, just because you have seen such a large stretch in some companies that have run so much. I mean, for example, you look at Nvidia, it ran up to 429. You look at some of the forward peg ratios for some of these companies, they're starting to price in quite rich growth, and so some rebalancing could make sense, in my opinion. Now, I suppose what we could do is we could take a peek at some short interest, and we could somewhat see what's going on with percentage of float, as well as nominal short interest for these various companies. For example, if you jump on over to Tesla, right now you're sitting at about 13.25% short. That works out to somewhere around $23.5 billion of short. You're about $1 billion short on SoFi. That works out to also here about 13% short. Look at a company that also rallied like Carnival Cruise Lines. You're somewhere on 12% short. I wonder if anybody's actually shorting the AI companies. Oh yeah, look at that. C3 AI, 30.5% short. Yikes. Palantir sitting at about 8.37% short. You've got the old school GameStop sitting at 21% short, and AMC 22% short. This is all according to data from S3 Partners right now. We've got a sort of a chart showing us the various short reads. Let's take a look at another one. Let's go with Neo, for example, about 8.1% short. How are the Qs doing? Go into the triple Q. Triple Q, 13% short as well. And that short interest has been relatively stable over the last month. If anything, it's been unwinding over the last day or so. And that makes sense with a large expiration coming up tomorrow for not only options, but of course, those programs on building your wealth linked it down below with price increases, phase one price increase effective tomorrow, which is basically or effective tomorrow at 11:59 p.m., which is basically like one free month if you're using buy now pay later, if you get in before that. So something to consider. Dave and Buster's short interest. Ooh, that would be interesting. Yeah, let's look at Dave and Buster's because they had a pretty ridiculous run there. 11.4%. Their earnings were great, and fundamentally, we looked at their earnings beforehand, and we suspected, the earnings had good potential. I personally didn't make a move on it, but we're looking at going, these fundamentals aren't bad at 31 bucks. These actually look pretty good. And so we were brainstorming potential moves in the course member live, and I know some people did make some moves on it, and that worked out very successfully. But this last 22% run was just insane. We'll see, I suppose, how markets evolve. But anyway, let's look at catalysts going forward. So retail sales will come out today. We'll get import prices. We'll get the ECB in about 26 minutes here. We'll get their rate hike. Excuse me. Tomorrow, you'll get the University of Michigan Consumer Sentiment and Inflation Expectations estimate. Next week, we'll go into housing starts. And then, of course, we'll also get into the Fed's preferred inflation gauge, which is the PCE gauge. PCE will come out on the 30th, along with, again, University of Michigan expectations. So that's about 2 weeks from now, really. Yeah, it's only the 15th right now. You'll have GDP annualized coming out on June 29th, new home sales on the 27th, S&P 20 city CoreLogic inflation or home price expectations and values for the last month on the 27th, as well as PMIs for the S&P Global Manufacturing and Services coming out on the 23rd. Working backwards a little bit there. But larger catalysts coming up today. In just about 37 minutes, we'll be looking at retail sales. And then, of course, we'll have the ECB rate hike expectation within about 20 minutes here. So we'll take a peek at those. A few more short interest requests here we could go through. We can hit some of these, absolutely. So there's some questions about Enphase, Target, Okta, and some of these others. Let's take a peek here. So Enphase is looking at, Target is looking at 2.07% short, so pretty low. Enphase is about 4.87% short, also relatively low, which makes sense at this level. Okta 3.6% short, pretty low. Ubiquity 6.7% short, pretty low. AMD, Intel, Nvidia. Let's take a look at those as well. Intel's only 1.6% short. Some of these sort of indicating they might be closer to these bottoms here. Nvidia, though, only 1.3% short, 2.3% short on AMD. Somewhat of a tell that people are afraid to short these. That's quite interesting. Yeah, that is very interesting. Afraid to short. Uh, oh, wow. All right, let's take a listen in on CNBC. Let's see what those folks are yapping about this morning, and see if we can add any commentary to it. So let's see what we got.
Software platforms, which are getting a lot of attention, OpenAI and so forth, but some of the specific applications that are really bringing innovation to industries that need it using AI and other kinds of technologies. And some of that for sure is happening in places like Silicon Valley. A lot of it's happening all over the country, and that bodes well for what we're trying to do at Revolution and Rise of the Rest.
Steve, you just mentioned Rise of the Rest, talking about all of these places outside of Silicon Valley and the tech areas. When you see San Francisco right now, you see Whole Foods and Nordstrom's walking away, owners walking away from hotels, walking away from all kinds of properties, mall properties even. I recently read an analysis that suggested something like this could cost San Francisco a couple of $100 million a year in revenue over the next couple of years. I'm sure you don't look at that and think I told you so or anything, but what do you think when you see this happening?
No, I think it's sad. I think San Francisco is a great city, and I've always loved San Francisco, love Silicon Valley. When we talk about Rise of the Rest, we're really trying to level the playing field, create more opportunity for more people in more places. It's not an anti-Silicon Valley thing. It's a pro the rest of the America thing. So I've been sad to see what's happening in San Francisco. It's become sort of what some call a doom loop, where there's a lot of challenges, crimes, where people aren't there. Because people aren't there, other problems happen, including hotels shutting down, stores shutting down, and so forth. I believe in San Francisco. I believe in Silicon Valley. I believe it will continue to be strong. I suspect there will be a rebound coming, but for sure right now it's challenging. It does create some opportunities in some of the other places. Certainly some people have left San Francisco to go to other places. That helps strengthen the startup communities in those other places, which if you take the long view, I think is good for the country. We want a more dispersed innovation economy. We don't want all our eggs in one basket. We want to create jobs and economic growth all across the country. And so having people move, having capital flow to other places, I think is important. That's why we've been talking about this for the past a decade, even worked on legislation like the Jobs Act a decade ago. But certainly the challenges right now in San Francisco, I think, are a wake-up call that cities, mayors in those cities, business leaders in those cities really need to recognize that something fundamental has happened. And how do you get people back to these downtown areas and create a vibrant, safe communities?
You think that's possible? You think that
of course
eventually
it's possible.
people are all going to get back to these buildings? We just talked about how New York City, I think last week, finally got above 50% occupancy. Granted, it was never at 100% before. It was closer to 70%. But for the first time since the pandemic, it was just in the last week or two that it actually got to 50.5%.
Yeah, we're in a different world, and it's a grand social experiment. And 3+ years ago, pre-pandemic, everybody thought they're going to always be in offices 5 days a week. 2 years ago, 1 year ago, we're all fully remote. Now it's much more in a hybrid mode. A lot of companies are bringing people back. Even some of the tech companies that announced fully remote policies have reversed those policies and want people back in the office. And so you're seeing a lot of movement in terms of getting people back in the office. I think people realize, well, it can be more convenient to work remotely, and you can do some things that can be very productive on specific tasks. Creativity, collaboration, some of the things that make young companies, startups so special, being together does really have value. So I think the momentum is towards that. I think you will see people in offices more, but we'll still have some kind of new normal where there's a kind of a hybrid, and it will benefit some of these Rise of the Rest cities, because one of the challenges they had is that as these companies grew, they weren't able to access some of the talent that really had experience with hypergrowth. Now they can by having some of those people be remote. So I think we're in a new world. We're all adjusting to it. I think it creates a lot of opportunity for a lot of people and a lot of places.
Yeah. Hey, Steve, congratulations to you and Ted and the rest of the crew for seeing Kava so early, and thanks for coming on with us today.
Thank you all. It's great to be with you.
You can rattle off those investments. He's going to look down at his notes.
No, he knows it. He knows what he's doing.
10 things, exactly what they do.
I love that Ted Leonsis saw the Kava thing because his Middle Eastern connections saw it happen. Good story.
He might be smart. You forgot that it wasn't it the Inflation Causation Act? What was the name?
Yeah, the Inflation Reduction.
Oh, that's hilarious. The Inflation Causation Act. Oh man. Yeah. Well, as Goldman Sachs predicts, that $387 billion of Inflation Reduction Act climate change related spending is probably going to be more like 1.2 to 1.4 trillion dollars of spending, which is expected to be at least somewhat inflationary. But that was a good one. Yeah, definitely sad what's happening in San Francisco, and agree about this transition with work from home. Actually, I made a real estate video yesterday. Hopefully, you had the chance to see it. If you haven't yet, I think it's a good watch. But I talk about this concern over, hey, if we have a larger transition in real estate in terms of demographics, then it's going to take a little bit longer to figure out exactly how. Uh, to recognize which markets are the most ideal to potentially establish a foothold in. If a lot of them potentially were propped up by COVID and work from home, and now you have a reversal of that. So we'll evaluate what happens. It does look like Nick T posted his piece. I think it's probably worth evaluating what Nick T's piece looks like. So let's take a look at this. So let's take a look at what Nick T has to say in the Wall Street Journal this morning. He got a little schooled by Jay Powell yesterday, or at least that's how social media picked it up when Nick T was asking about the pace versus the level of hikes, and Jerome Powell made it clear that there's a big difference versus pace, and the reason they pause is because now they can focus on staying at a level for a very long time. So we'll go through what Nick T here together says. However, it's worth noting a few things as we go into Nick T's piece. First of all, Bloomberg is running headlines that the Fed is indicating at least 2 more rate hikes, or that Powell is. I don't think Powell was doing that at all, but the summary of economic projections was. Obviously, the summary of economic projections coming in hot at 5.6, though worth noting, very good point, that the summary of economic projections came out on Friday, or was submitted by members on Friday, which is before both CPI and PPI data. Despite this, though, markets are red with a 71% chance of a hike on July 26th. And by September 20th, we're looking at a cumulative about a 77% chance of at least one hike, if not two. So let's take a listen here to what Nick T says. Also keep in mind that Richard Clarida this morning did indicate that maybe only one more rate hike would be expected, and that 2 would be a bit aggressive. And so we'll see. There's a lot of talk that the Fed is actually closer to being done than where they where people might think that they need to go, and that would imply maybe one more rate hike. But let's see Nick T's piece here. So Fed officials agreed to hold rates steady after 10 consecutive hikes. The new summary of economic projections after their 2-day meeting suggested they were leaning towards slowing down their increases versus stopping them altogether. Most of them penciled in 2 more rate increases this year, which would lift them to a 22-year high. They really needed to hammer home the message that this was not the end, which they did. And this was something that we had all suspected, that is the Fed really actually thinking about raising rates 2 more times? Or are they just trying to indicate some messaging to the market that, hey man, don't think this is a pause. Let's go a little strong then and indicate or prove to markets that this isn't a pause. And let's send them a signal, even if we don't believe it, that this is just a a temporary skip. We even had Jerome Powell slip up and mention the word skip once, and then retreat and say, oh, well, I shouldn't call it a skip. Oh, so have you been talking about it being a skip? Anyway, in its post-meeting statement, the Fed implied the decision to maintain benchmark Fed funds rate would be at the level where it is now would be short-lived. After holding the Fed funds rate near zero following the pandemic, the Fed has raised. Okay, we know the history of it. Now we want to get some more future leaks here, Nikki leaks. We don't need a history lesson here. Wednesday's decision not to raise rates is a continuation of that process, said Jay Powell. Common sense to go a little bit slower, yes. Officials had signaled growing disagreement in recent weeks over whether to keep raising rates. Some officials became more doubtful in March because of the banking crisis, but it's too early to see signs of the banking crisis. That's true. Jerome Powell gave a lot of "I don't know" answers yesterday. A lot of "I don't know if we're at a restrictive level of rates. I don't know if inflation's coming down. I don't know if the banking crisis has taken a hold yet." A lot of "I don't knowing" yesterday. Again, leading some people to believe that Jerome Powell's aggression potentially yesterday was maybe somewhat disingenuous and actually misplaced. Powell and some colleagues had hinted at a potential compromise last month in which officials would forego a rate rise in June while leaving open the prospect of an increase in July. A potential compromise hinted at last month. Interesting. But recent economic data and hiring on inflation have been stronger than many forecasters anticipated. This is true for hiring. I wouldn't argue this was true for inflation. Inflation seems to have come in softer in the latest reports. It's not clear what the criteria is they're looking for. Projections showed that 12 of the 18 officials think they will need to raise rates up to potentially 5.5%. Yeah, that's true. Actually, it was 16 of them, rather, projected an increase to 5.25 to 5.5, and 12 projected 5.5 to 5.75. Gives you a little bit more of a breakdown on the piece here. Another 4 officials projected they would need to go up by only a quarter point. Exactly. Okay, there's the fill-in. Powell has kept his committee united since inflation surged 2 years ago. It's true. Every vote so far has been unanimous. So that's the way somehow Jerome Powell is, as they say, corralling everyone. It will be harder next time for them to raise rates than they realize, says Richard Reinhardt, a former senior Fed economist who is now an economist at Dreyfus Mellon. This is actually something that Jeffrey Gundlach, billionaire investor, also indicates. And he's He's very bearish right now. He actually thinks people should be long bonds right now. Yeah, he's anti the stock market broadly, from just based on some of his commentary. But his latest commentary yesterday suggests that the Fed is done, that a pause is in, and that you shouldn't be confused that this is a pause and the Fed trying to signal hawkishness while in reality indicating they're done. Yesterday, I did run a Twitter poll with about 3,250 votes. 51.2% of y'all indicated the Fed was done. However, the other 48.8% of you indicated the Fed had either a 25 or 50 basis point hike left in them, with that vote about split on how much. The data probably will be a little bit more ambiguous. Their headline explanation is that they will know much more in 6 weeks, but the fact is they won't know much more in 6 weeks. Chances are they'll be more confused in 6 weeks. Well, that's why I think they'll probably end up pausing through to September. The economy has shown only modest signs of cooling in recent months. The share of workers voluntarily leaving jobs has returned closer to pre-pandemic levels, suggesting that the tight labor market has eased a bit. But steady hiring and wage gains could sustain elevated inflation. Although, in fairness, the Fed did just throw, and Powell did briefly comment on it, they did throw cold water on the idea that wage gains are certainly linked to higher inflation. This is thanks to a Federal Reserve piece out of the Bank of San Francisco, where the Fed's indicated that, hey, maybe there isn't as strong of a link between inflation and wages as we had previously thought. It doesn't look like Nick T is choosing to talk about that at all. Housing market, one of the sectors hardest hit by last year's rate increases, has seen some improvement, illustrating how difficult it has been for the Fed to slow the economy and balance supply and demand. True, because there's just no housing supply. So what do we take away from this? Well, I think what we take away from this is, well, that of course tomorrow there's an expiration of those programs on building your wealth. All of those. I mean, look at all the different programs we have, and they're phenomenal. You've got the income side and the investing side. A lot of people didn't realize, by the way, we had the property management and rental renovations course. That's a very good one. We've got someone with over 35 years of property management experience joins me in that one. Really exciting. Real estate investing, stocks, obviously. But all of these programs and the income course is getting a price increase tomorrow at 11:59 p.m. That's the 16th. And that'll be part of the phase 1 of 4 phases of increases. And that's as we're coming out with a large new lecture set at the end of these 4 phases. But I guess my bottom line takeaway of this is, look, we expected the Fed would have to talk dirty to us if they paused. There was no way they were going to be able to pause and talk nice to us, because that would just sustain a market rally. And that's kind of not exactly conducive of encouraging inflation down. We talked about that. We talked about the wealth effects beforehand. We somewhat saw that. I don't think anybody was expecting the Fed to be this hawkish. We were expecting a hawkish pause, but not this hawkish. However, when we evaluate that, well, but wait a minute, the summary of economic projections was actually submitted before this week's data. It kind of makes you scratch your head and go, what's the point of the summary of economic projections if you don't put it together when you have all the data? It's a little frustrating, and maybe that's why Jay Powell was actually frustrated yesterday. Maybe, just maybe, he was frustrated because he realized this data came in softer than expected, yet he had to present this summary of economic projections that was more frustrating, perhaps, and unrelated to the latest data that we've actually received. So we'll see. But that's the latest that we have from the Fed. And now we're going to move on over to looking at the European Central Bank and their rate increase. Oh, I suppose I could quickly also note this. We talked about this a little bit earlier in the stream. I figure I just show this quickly as well. One last thing is this world interest rate probability chart right here is still indicating a bias towards potentially a pause, keeping at a pause in July. This 5.25 level not being quite high enough to really indicate that push through, but that push through does get priced in for another rate hike in the September and November meetings. And as expected, many economists now punting their recession expectations. That's something else we've been talking about for a few weeks now, where we've said that, hey, look, it's highly likely economists are going to realize, oh crap, Q3 is only 2 weeks away. I guess the recession won't come in Q3. And sure enough, that's exactly what we've been getting from economists and new analysts. Here's, for example, a piece here. U.S. economics. We have revised our outlook for a delayed downturn and higher policy rates and push out our anticipated slowdown in the U.S. economy by 2 quarters. Now out to basically the end of the year rather than Q3 and potentially Q1. So that gives us a full catch up here, and we will now see what CNBC is up to as we await the ECB decision. Sorry, one sec as I get.
Depend what is the labor market looking like by the time inflation gets down to 3%. So the Fed is really focused on payrolls. 283,000, that's the 3-month moving average. That is just incredibly hot. But at the same time, every other labor market and data point we look at outside payrolls says that payrolls growth should be moderating. So our view right now is rather than say payrolls and everything else is wrong, we're saying everything else is probably right and payrolls growth should be moderating. If the unemployment rate is rising, it's above 4%, let's say, when we get to 3% inflation, it's going to look a lot different from the Fed's perspective in terms of the balance of risk.
I think we take out used cars and we leave in energy.
Well,
And then we'd be at like 2% already.
yeah, let's just look at the metrics we want.
but look how energy does filter through. And they say, oh, no, we're
That's
not
right.
looking. Yeah, well, of course, energy's down, but that we don't care about. That's what causes all the inflation.
The Fed's official target is headline PCE. They focus on core PCE because food and energy are volatile. And if you want to look at where things are going in the future, historically, core has been a bit better than that. But I think no one is denying that the experience of the average person, it's all about food and energy. It's a huge part of the consumption basket.
Glad. Kelsey, thank you. Appreciate it.
You spend all your time thinking about this. That's what I gleaned from that. Wow. You know a lot of stuff. Coming up, thank you. Coming up, we're going to bring you the latest interest rate decision from the European Central Bank, plus a full slate of economic data from here in the United States. And we're going to speak with Connecticut Governor Ned Lamont. Connecticut's new budget includes the biggest income tax cut in state history. Talk about an oxymoron. He's a Democrat. You're watching Squawk Box on CNBC.
All right. So ECB decision comes out in about 2 minutes. They'll probably still be in commercial, so I'll just cover it. Kevin had Canadian lumberjack. Yeah, I'm working on getting the level 99. You got to get that woodcutting skill up. As I was chopping, I was waiting for a bird's nest to fall so I could see if I get a special prize. But that didn't happen. Oh, hello, Mr. Black Squirrel. At least it's not a black swan. Anyway, okay, so we're about a minute away now from ECB decision. Let's see here. Where are we going to find that? That's got to be here somewhere. So ECB. Okay, so we are expecting the rate to go from 4% to 4.25% for what's called the ECB marginal lending facility. And the main refinancing rate is expected to go from 3.75 to 4%. So a 25 BP hike is expected from the ECB in about 50 seconds. Are we going to get to meet Kevin's sell-off? Yes. Hey, Steve, where are you located? And Lauren, what's our favorite thing of Canada so far? Boating? Timmy's and butter tarts, she says, not boating. For some reason, not boating. Timmy's and butter tarts. Anyway, all right. So let's see here. 15 seconds to the ECB decision. 25 BP expected. Remember, we got the restart to rate hikes in Canada after a 4-month pause. We got a 25 BP hike. Now we're expecting a similar hike from the ECB, especially after the Fed's hawking yesterday. And yes, it is a 25 BP hike. It just came in. ECB officially raises 25 basis points. That is as the survey expected, though. So not horribly surprising. So we got exactly what we were looking for. And in about 15 minutes, we'll get United States retail sales data. And we'll evaluate how that retail sales data comes in. For retail sales data, we're expecting the month-over-month headline figure to be negative 0.2%. And if you exclude autos, we're looking at 0.1% of growth. Exclude autos and gas, looking at 0.2% in growth. So think about that as negative 2, 1, 2. We'll also get an import price measure as well as an export price measure. Both of these are expected to be negative in the deflation camp, especially year over year. All right, let's listen to CNBC and see them tell you what I just told you, hopefully with a little bit more context as well. And let's turn it on.
By a quarter as expected. 4% is the, which one is that? That is the marginal lending facility. 375 is the benchmark rate that everybody watches there. I'm just getting the headlines right now. It says ECB staff have revised up their projections for inflation, ex food and energy. So that tells you they're not quite done yet over there in Europe, especially for this year and next year, owing to past upward surprises. Let's see what they did with growth. Slightly revised, lower their economic growth projections for this year and next year. They expect the economy to grow by 0.9 in 2023. So Germany's in recession, of course, but not necessarily a projection here from the ECB staff that the full euro area will be in recession. I just want to show you guys real quickly the difference between Europe and the U.S. when it comes to inflation. You know that we started earlier, went more aggressively, and so we've had a little bit better results. Perhaps there are whole other reasons than monetary policy, but you can see that inflation did tick down earlier and is lower than the euro area by about 2 percentage points. So they have more work to do. I have not had a chance to read here. There's some talk about whether the ECB pauses in July. But I haven't read the full statement. I'll come back with you at 8:30 with whether or not there's any talk, guys, of a pause in July. But
all right, I will just go look at the statement with y'all right now instead of them. We will look at it right here because it's right here. Inflation has been coming down, but is projected to remain too high for too long. The Governing Council is determined to ensure that inflation returns to its 2% medium target. Ooh, I want to be on a Governing Council. Doesn't that sound so much cooler than a board? Board sounds boring. Be on a Governing Council. You want to be on a Governing Council, Lauren? What? Governing Council? Would you rather be on a board or a Governing Council? They're equally terrible to Lauren. Okay, never mind. So it's determined to ensure that inflation returns to 2% its medium target in a timely manner, therefore raising by 25 BP. Okay, the rate increase today reflects the Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation and strength of monetary policy transmission, blah, blah, blah. Projections. Okay, here we go. The Eurosystem staff expect headline inflation to average 5.4% in 2023, 3% in 2024, and 2.2% in 2025. Wow. So it really they're really expecting it to take a minute to get inflation down. Yeah, let's see how the FTSE is behaving. So if you look at the FTSE 100, what do you mean it's dropping? It's like it's up on the day. It's green on the day, and I mean, unless there's like a lag between when at least the Google stock chart gives it to you. Year to date, the FTSE's up 0.77, and the FTSE's not even the Bank of England. So why are we even looking at the FTSE? What we should be doing is looking at the DAX. DAX stock. There we go. That's better. Okay, that makes more sense. So the DAX down about 63 bips today. Actually, much of that already. Oh, but Google only goes up to about 205. So I don't see it in the last 14 minutes. Fine. All right, let's keep going here. Indicators of underlying price pressure remain strong, although some show tentative signs of softening. Staff have revised up their projections for inflation for core, especially for this year and next. They now see it reaching 5.1 in 2023 before it declines to 3% and 2.3% in 2025. That's the core level here. Staff have slightly lowered economic growth projections for this year and next at 0.9 for 2023, 1.5 for 2024, and 1.6 for 2025. This is 3 years of relatively slow growth, which, that's sort of the soft landing narrative, is that soft landing narrative, it should not be confused with growth. It's like a slowdown, right? Soft landing is, no. We are still coming to a stop. It's just hopefully a slower, calmer stop. Yeah, so I mean, here what you have is a little bit of hawking from the ECB as well. What you get is you get a 25 BP hike. You get a little bit of a revision up on inflation expectations and a little bit of a revision down on growth expectations. But it really showcases to you how we're going to be dealing with this for a while, which is unfortunate. Well, let me put it this way. For the stock market, I think the stock market is already pricing through the time that it's going to take to get a lot of this inflation down. I don't think we're going to revisit the lows of last year. However, the real estate market, I don't know how long it can keep up with rates this high. Right now, with the lack of inventory, real estate has hit a new equilibrium where real estate has started rising again this year. But that's not a foregone conclusion for the rest of the year, especially if we do end up seeing this for longer portion end up being for a lot longer. Bonds again rising. And I find this so incredible that the Fed would pause and the 10-year Treasury would actually rise. That was unexpected. I was expecting it to at least nominally fall, but we have not seen that yet. So I agree that true lagging effects are still yet to be felt. We shall see. It'll be, but you know what? That gives us some entertainment, because otherwise we wouldn't have any entertainment to talk about. Anyway, we'll go back to CNBC over here. What's this tax cut they're talking about? And then in the meantime, I'll grab this another thing I want to talk about. And then we're going to talk about retail sales. So listen in here just for a moment. Let's see what they have.
New Haven to New York in half an hour less time within the next 7 or 8 years.
Yeah, that's it's good. How about across the board? Would you at this point just, and I don't know if you've ever got any national aspirations or anything, but at 31 or 32 trillion in total debt, what would be your advice to how we get out of that? Would it be entitlement reform? Would it be, do you think we need to raise revenues, raise tax rates, raise corporate tax rates? How would you handle that? I know that you focus on Connecticut, but if you were to give advice.
I think I do a little bit all the above of what you did. I mean, here in Connecticut, I've got to be very conscious of the competitive environment in the greater New England area, where we have, some of the lowest tax rates in the Northeast. That's great. Some may say I'm the tallest guy in the pygmy colony. But then I also have to look nationally what's going on. The federal government, I think, has a little more flexibility And I got to tell you, people want to make sure that the feds are getting their fiscal house in order. Whether that requires a little bit on the revenue side as well as cuts on the spending side, I think we got to get closer to balance.
Do you foresee having to reverse any of this in future years? I mean, how do you have to control spending? And a lot of times we see states that suddenly they have a surplus, and you look back 2-3 years after that, and it always seems to be gone. They always find a way to.
Let's pause on this. This is mostly just related to Connecticut here. So putting a little preview on retail sales, looks like headline retail sales are expected to decline in May, given actually a lot because of potentially car sales falling. Auto sales will dent the headline as unit sales of light vehicle sales declined to 15.1 million in May from 15.9 in the prior month. With more consumers struggling to make car payments, pent-up demand for cars may not last. Ooh. Tesla offers months of free fast charging to move inventory. Tesla started offering 3 months of free fast charging in the US to clear its global inventory of Model 3 sedans before the end of the quarter. The offer on new Model 3s applies to Tesla customers who take delivery by June 30th. Ooh, make sure to use Kevin's referral code so I could buy Tesla short shorts. Actually, I already ordered some Tesla short shorts, so just more Tesla short shorts. Go to metkevin.com/Tesla. Anyway, the company is offering the perk even after all the versions of the sedan became eligible for the full $7,500 tax credit. And investor concern over Tesla producing more vehicles than expected, than they're able to sell, blah, blah, blah. It's the same thing as always. All right. What else we have here? Oh, Sam Bankman-Fried's prosecutors in his fraud case asked the judge to set aside some counts. U.S. prosecutors in the case against Sam Bankman-Fried asked the judge to set aside 5 counts the FTX co-founders contesting to avoid delaying the trial on other charges. Wednesday night letter, the Manhattan District Attorney said a Bahamian court ruling that Sam Bankman-Fried won earlier in the week on those 5 counts would likely delay the trial. Oh, so now they're trying to move those other 5 out of the way. Gotcha. All right, delays, court delays. A court and delay, I feel like that's like synonymous. Anyway, so we are now 4.5 minutes away from retail sales data. Let's see what we get here. Looking at a little bit more of a preview here. We've got tech stocks leading the declines as in both the United States and Europe's stock 600 after the ECB raised its rate by 0.25 percentage point. Let's see. Then we got the ECB moved after the Fed left rates unchanged, but they were hawkish in their commentary. Blah blah blah. Okay, we already know that. That is not news. All right. Traders see ECB inflation forecast upward revision as hawkish. Yes. ECB has modestly revised its inflation forecast upward for 2023 and the following 2 years while revising down its GDP outlook, which traders appear to be interpreting as a hawkish outlook. And therefore, you're starting to see, the stocks rotating down a bit in Europe. There's a policy and market lesson in Chinese exceptionalism. If you thought that market's reaction to the Fed announcement, or at least Powell's press conference, were a little perverse yesterday, today has brought a return to rationality. Equities are lower and yields are up across the curve, including the 5-year, punching the 4% threshold. There have been a host of factors suggesting that stocks should take at least a short-term breather. And it's not like Powell did much to dispel messaging from the hawkish dot plot. Yeah, only a little bit, not much. Let's see here. Based on the pattern from most developed market central banks, anyone hoping for the ECB to lay loud dovish guidance today might be disappointed. Oh, that little note came 8 minutes before, right? Well, they came out hawkish. Okay, good. 3 minutes now from retail sales data. Let's get this data. So let's see here. No short shorts for live stream, but you can't see what pants I'm wearing in the live stream. So let's see here. All right, let's get this eco data. Oh, is it one of those for me? Oh, thanks, Lauren. Lauren's bringing me a beautiful, delectable cup of coffee. Now you have to come this way so the camera can see you. Here, let me turn it around since this camera has a gimbal. Should I turn it around on you? No? I'm turning it. Oh, dirty, dirty. All right. 2 minutes from retail sales. Yeah, okay. So let's get retail sales data. After retail sales data, we will explore the retail sales data a little bit. And then I want to look at some of the institutional docs that I've been looking at yesterday, and some of the institutional reactions to the Fed meeting yesterday. I think some of those will be quite interesting. So we'll look at some of these. JPM has got one. I like this one. They're kicking the door in again is the headline on JP Morgan's. You've got some other commentary as well. So we'll go through some of these. But they tend to be entertaining getting the reactions over here. Let's see what Goldman's response was. Goldman, will take a second. Oh yeah, here we go. The FOMC delivered a hawkish surprise to most market participants. Yeah. All right. So we'll look at those after we get retail sales. All right. 50 seconds to retail sales data. Let's go through the expectations again. Retail sales data is expected to come in at negative 0.2% on the advanced month over month. We are looking for that to plummet from last month's hot retail sales data of 0.4%. Excluding autos, we're expecting to go from 0.4% to 0.1%. Excluding auto and gas, we're expecting to go 0.6 to 0.2%. And in the control group, we're expecting to go from 0.7 to 0.2%. We're also going to be getting import prices. Import prices expecting to go from 0.4% to negative 0.5% month over month. Excluding petroleum, negative 0.1%, year over year, negative 5.6%. All pretty deflationary figures here. And okay, retail sales, oh crap, comes in hot. Retail sales advanced month over month comes in, all of them come in almost hot. Advanced month over month comes in at 0.3. Well, there you go. That reiterates a Fed potential move. X auto does match at 0.1. X auto and gas comes in at 0.4. 2 out of 3 of those well above the survey. Import prices did come in lower, though. Import prices coming in at 0.6 versus 0.5. Import prices, excluding petroleum, coming in at negative 0.2 versus negative 0.1. Import prices year over year coming in at negative 5.9 versus the 5.6 expected. Export prices coming in at negative 1.9 versus 0.1 expected. And then export prices year over year coming in at negative 10.1%. Initial jobless claims just came in at 262,000. That's above the survey of 245,000, but it is roughly in line with the 262 revision of last month, last week. These are weekly numbers. Continuing claims coming in at 1775, slightly above expectations. So jobless claims and continuing claims slightly above expectations. Retail sales coming in hot, and import-export prices coming in soft. So it really reiterates that the rest of the world is suffering a little bit more than the United States, with the United States data coming in here hotter than expected, especially with this warmer retail sales report, again, coming in at positive 0.3 versus the negative 0.2 that was expected for retail sales. So another bit of hawkish news there. We could take a brief, no, CNBC is really just going to be reiterating the numbers that we have right here. So let's go into the actual monthly retail sales report and see if we can get the data. Advanced monthly retail sales. Yep, we have them here. Okay, let me get the full PDF of this, 7 pages long, so we can go through the actual retail sales report together. Now we're going to do that in just about 5 seconds here. While we wait for that, keep in mind we have a price increase for those courses on building your wealth. Phase 1 starting tomorrow. You can see all 4 phases on screen right now, with the price increase starting this Friday, and then the largest price increases by phase 4. These are all cumulative, so they'll keep going up. These will all add together, and that's because we're adding new lectures to all of the courses listed here over time, with the first next batch coming out for real estate investing in stocks and psych, and the productivity course. So let's now jump on over to what we have for the retail sales report. Retail sales report is right here. And let's see what the report says. This is from the U.S. Census Bureau. The report came in plus 0.3%, hotter than the expectation, but a little softer than last month. Total sales from March through May were up 1.7%. Fine, that's the quarter. Okay, we want to know the monthly data though. Let's get into some of the monthly data and let's see where the hotness is coming from. So here's the chart on the, it's a little difficult to see exactly where we want to be. We want to be here, May adjusted 2023. So we want to be in the column here. We do want to be at the percent change though. So let's go to the preliminary percent change and let's go to the April chart. Let's use this chart, May from April. So we're looking at the May number from April, and this is going to give us a month-over-month indication of where some of that heat came from. Whoopsies, that was yesterday's report. Let's go here. There we go. Motor vehicle and part dealers actually came up 1.4%. I believe this was expected to be negative. You had furniture and home stores coming in at 0.4%. Yeah, it had to have been expected to be negative because when you get the excluding motor vehicle and parts, you actually get a smaller number than the headline number. So in other words, even though we were actually expecting car sales to be weak, it looks like they actually came in stronger than expected in the retail sales report. Maybe that's good for Tesla. You've got electronics and appliances only at 0.2% here. That's pretty low. Building materials. You know, we saw this in the PPI report that construction was really booming. And this would reiterate that, this building materials explosion here of 2.2%. Food and beverages and grocery stores at 0.3 or 0.2%. Health and personal stores, 0. Gasoline stations coming in at negative 2.6%. Clothing at 0. Sporting goods at 0.3. General merchandise, 0.4. Miscellaneous store and non-store retailers. These would be your online, well, the bottom non-store retailers is online. Miscellaneous stores at negative 1%. So really what was hot here? Well, what was hot was building materials and autos and auto dealers. We were expecting the auto numbers to come in soft, according to what the Bloomberg economists were expecting. But once again, they were wrong. The economists were once again wrong. Auto sales actually soared, apparently. That is quite interesting. I'm trying to see if there's any commentary on this so far. So far, there is not. No commentary just yet, so we'll stay tuned for that. Okay, let's keep going through this. Okay, motor vehicle parts and dealers. Yeah, look at this. This is your, let's see, current month, percentage change, percent previous to current month. Previous to current month. Yeah, it's absolutely autos, actually furniture over here as well. We saw construction was up there. This is, let's see here. This is the percent change. This is percent change advance. This is the advance. This is median standard error for percent change. I'm trying to see how this chart differs. Estimated measures of sampling variability and revisions. These are the revisions. Let's ignore this one for a moment. So we'll focus on this one, which gives us a more clear understanding. The revisions get a little funny to understand. So this gives us, in my opinion, some clearer data. How does this, though, compare compared to March? So rather than just looking from April to May, how are we looking if we look at March through May, just to get a little broader segment? The hotness is actually in the same area. Look at that. Autos. Building materials are actually negative over here. So you have more variability. See, look at these changes here. Electronics and appliances were hot. Building materials were actually down. So it was really in this last month that autos reiterated heat. Same thing with the year over year that you got on autos over here. Autos, autos, autos. People just keep buying cars. What is this? And the expectation was that this would come in soft. Whoopsie daisy. Teslas are selling. Yeah. Used cars and shelters are lagging absurdly, and they know it. Quite possibly. Elon just tweeted about Powell being wrong about rates not getting cut in the next couple of years. That's not what he said. Oh, that's not what he said. So there's been a lot of debate about Jerome Powell making this argument that the Fed is not going to cut rates for the next 2 years. This is another mainstream media argument that, oh, Powell said he's not going to cut rates for 2 years. Problem is, if you look in context of the question that he received, Jerome Powell was asked about 2-year projections. So he was answering about 2-year projections. He was not saying rates are not going to get cut for 2 years. That's not what he was saying. If you look at what he said out of context, that may seem like that's what he says. But what he actually did is he referred to his formula again. He referred to his formula, which his formula is take inflation expectations, add some level of restrictiveness, and that's what nominal rates should be. So if inflation expectations, as he told us last month, are 3%, and you want rates to be 2% in terms of, or you want real rates to be 2%, well, then that means you need nominal rates to be 5%. Well, that's where we are now. 5% minus inflation expectations 1 year out, about 3%, 1 to 3 years out. Then you get to a restrictive real rate of 2%. And Jerome Powell, in this response to, they're not going to cut rates for 2 years. In his response, he's talking specifically about 2-year projections. And he actually made it clear in his response that, well, look, as inflation falls, you're going to have to adjust rates down to keep rates at a restrictive level that's equal to what it has been. Because if you don't reduce rates, you're actually increasing rates by not reducing rates. That's what he said. However, a lot of people were very, very confused by Jerome Powell's response because he was responding to a question specifically about this 2-year projection. And I think that really skewed people's understanding of what he meant with no cut for 2 years. So yeah, I want to add some good clarity about that. Jerome Powell did not say they would not cut for 2 years. He did say they would not cut this year, but that's okay. The bond market's already priced that in. But this no cuts for 2 years, it literally defies the very definition he gave in the response and the very definition he gave last month. So no, that's a fundamental, out of context misunderstanding of what Jerome Powell suggested. Okay, good. So now that covers retail sales. That covers this rate myth, we'll call it. And now let's look at some of the market and doom and gloom headlines coming through. All right, so let's see here. Okay, so if I go to looking at a little bit more at the ECB, rate hike coming in as expected, updated forecasts are rightly drawing in attention as inflation is now seen as overshooting a bit. Higher for longer story. Thanks. Yes. Language on what comes next is a copy and paste for last month, though, with the exception of the change in the forecasts of the data. Let's see what we have from CNBC's on commercial again. They're always on commercial. They're always on commercial. See, we don't have commercials here, other than, of course, the pitch for the programs I'm building a wealth link down below with the first price increase tomorrow. All right. Euro stands right in the middle of its recent range. Okay, that's fine. It's regarding foreign exchange trading ranges. Let's see here. And we should have retail sales unexpectedly rise in sign of consumer resilience. Retail sales unexpectedly rose in May. Yeah, a lot of this because of vehicles, though. It seems, though. Let's see. Sales at 10 out of 13 retail categories advanced, reflecting greater spending on building materials and cars. People still buying cars. While figures came in stronger than expected, they still show moderating consumer demand from the last year. Americans have kept spending against the backdrop of elevated prices and supported by the vibrant job market. Bloody. That's fine. Okay, let's listen in to CNBC and see how they're handling all this news. Share screen. Deb, share on.
Rattled investors this morning, Joe.
Yeah, I don't know if there was an outlook or what. That's an important bellwether sort of in terms of input costs and consumer and everything else. Huge supermarket chain based in the Queen City in Cincinnati. Dividend news this morning. Delta Airlines declaring a quarterly dividend of 10 cents a share. Delta's payout has been suspended since March of 2020 when the pandemic hit. Now it's back. And Target upping its dividend by a little less than 2% to $1.10 per share.
Meantime, signs of life in the IPO market. Mediterranean restaurant chain Cava pricing its IPO at $22 a share, above the initial expectations, with public debuts quiet since the pandemic. Cava will be watched really perhaps as something of a bellwether. We'll see whether other companies might want to tap the public markets, given everything that's happening. Renaissance Capital saying that of the 44 IPOs that have priced shares this year, only 20 were for U.S. companies. And you don't want to miss a first on CNBC interview with the CEO of Cava. That's going to happen next hour on Squawk on the Street, right around the opening bell.
Ahead of Monday's Juneteenth holiday, Transportation Secretary Pete Buttigieg tweeting that he expects today to be the busiest day for air travel since before the pandemic. Joining us right now to talk about the rebound in air travel as well as inflation.
A quick note, the stock market is actually closed on Monday. All my employees get a paid day off, but I won't be streaming either, so I guess I kind of get a day off too. But anyway, it's kind of crazy. I wasn't expecting that. I'm like, oh, I guess we have a 3-day weekend.
Of the economy when it comes to transportation right now.
Well, and you're seeing the numbers. I just watched them briefly before I came on. And so things are not looking overly negative, which is a good thing, certainly in line with expectations. I was with some credit card folks. They say that continues to be robust. The consumer spending aspect of that. Consumer stocks, of course, have hit some lows and are hopefully recovering soon. But from an industry perspective, the leisure travel, which had flattened for a little while, is back and rolling. And so things are just, as leaders, business people, tend to be optimistic because we have to be. But it's looking a little better. The rate, the Fed rate hike, hawkish pause, I guess is the term I've heard most often. Still suggesting a higher rate, which would impact some stocks. But, overall, it's feeling a little better. But from the vantage point of someone like me has with regards to consumer spending, at least at the airline level, it's still very fine. I'm in a resort in Puerto Rico to this back to business travel. It's a large event that I'm speaking at. I don't know, a couple of thousand people that are, from the firm that are here. So that's beginning to pick up a little bit. So at least from the perspective that we have on the airline space, it's looking okay.
That's what the pilots union might use to bolster its argument to try and get more concessions out of United. Scott Kirby, the CEO at United, has said that they've put a package on the table that they value at $8 billion, which would be more than the $7.2 billion deal that Delta signed with its pilots. The pilots are pushing back, though, and the union chairman there saying, look, they don't think it's worth $8 billion. They don't think it comes up to meeting Delta in terms of what they see just for disability benefits, profit sharing. This is pretty tricky negotiation to get through. As somebody who knows United very well, what are your expectations?
Listen, there are parts of my old job that I do not miss. This would be one of them. The valuation of all the component pieces. First of all, at United, we love our pilots. They're valued. The growth plan that Scott has put into place is contingent upon that. I mean, all of those things. It's just a matter of negotiation. And I think both sides tend to look at things just a little differently. I think United has some of the best perks and benefits associated with, in addition to what's on the table with regards to wages. So I just think it's a matter of time before they converge on the right thing.
All right. Whatever. Kind of boring. Let's go talk about something else. Let's go see what the suits are saying about these good old rate hikes. So let's do a little bit of exploring together, shall we? Because we got retail sales, we got the ECB data, we talked about the Fed, we talked about the 2-year comment, we talked about Elon, we saw auto sales were hot in the retail sales report, all that good stuff. Now, let's talk about Goldman Sachs' response. So, what do we have here? The FOMC delivered a hawkish surprise to our and most market participants' expectations today, with a dot plot showing the median projection of 2 additional rate hikes rather than 1. Chair Powell said during his press conference the main reason for the shift up in the docks is a disappointingly slow decline in core inflation so far. Another key takeaway from the June meeting is that FOMC participants see a more moderate pace of tightening is appropriate now that the funds rate is closer to its likely peak. We think that likely means the FOMC envisions hiking every other meeting. This is an old school strategy that I personally think was really bad for inflation expectations. But maybe, in theory, you could go hike July, skip September, hike November, skip December, cut January. In theory, you could do that. I don't think so, based on the latest inflation data, which again, their summary of economic projections didn't reflect, but whatever. We have not made any changes to our forecast of one additional hike in July. The combination of the hawkish surprise in the dots and the hint at an every other meeting pace strengthens our confidence that the FOMC will likely hike in July and make the second one more likely in November rather than September, although neither is in the baseline. Okay, Chair Powell said the main reason for the increase in the dots was the increase in core inflation. We already know that. Another key takeaway was that the Fed funds rate is closer to peak. However, he was careful to say that participants had not yet discussed moving to an every other meeting pace of hikes, but we suspect this is in fact the pace of the FOMC, or that the FOMC has envisioned. Okay, we expect realized inflation to slow meaningfully by November, when an every other meeting pace suggests the FOMC might consider hiking again after likely in June. Interesting. Could be one way to look at more data going out towards this is their forecast. So this is where we are right now, is this dotted line right here. And then their forecast on core services X housing is this gray bar here. And you can see it kind of takes a hot minute to really actually get down. It seems relatively flat. I mean, even the iPad wants to make my line flat here. All right. And that, of course, is that's the headline figure. So if you're looking at core month over month, that would be the red highlight right here. And this you could see slowly dragging down from around that 0.3 level to around that 0.2 level, which, keep in mind, 0.2 is still synonymous with about 2.4%. So a little bit of patience required over there. JR asks, have you changed your opinion? Your initial thought was right, IMO. Pause equals no more hike. No, I wouldn't say so. I think the SAP is well, it's always been wrong. The problem is, and this is sort of a downside, is that it's always been wrong to the low side. And so it is a little interesting that one would make the argument that, oh, it's wrong this time to the upside. But I think that just by the virtue of having such a hawkish statement, it's almost like you're imposing another hike without imposing another hike. Like, being really hawkish is almost as good as giving the market another hike. I don't personally think it's necessary, but I was also expecting the Fed to talk a little bit more about patience and in getting inflation down. But I think they just blatantly refuse to indicate any kind of patience, other than suggesting that it's going to take really until 2025 to get inflation down. Because I think they legitimately are worried that if they say the wrong thing and indicate patience or indicate that they're absolutely done, then inflation expectations will unanchor, which Jay Powell did reiterate that they were anchored, and he was happy about that. So here's Morgan Stanley's reaction. Powell stressed that this is not a skip. So Morgan Stanley, let's see what they have to say. So a slight adjustment in the statement should not be ignored. As expected, the Fed held the range of the Fed funds rate steady. But we think this slight change in wording from in determining the extent to which additional firming may be appropriate to in determining the extent of which additional firming may be appropriate. What's the difference there? In determining the extent to which additional policy firming may be appropriate, of which additional firming may be appropriate. Wow. Is the consensus of the committee keeping further policy moves in question despite a hawkish SEP? Oh, this is interesting. Of additional policy firming. To which additional firming? I'm personally, I have a hard time breaking apart this one. I think what they're trying to say is they're, while maintaining a tightening bias in the statement, is a consensus keeping further policy moves in question despite more hawkish. I'm not exactly sure how to read this. As expected, the Fed held the range of the Fed funds rate steady while maintaining a tightening bias in the statement. But we think a slight change in wording from those statements is the consensus on the committee, keeping further moves in question despite a more hawkish SEP. So what they're saying is they're trying to say, hey, the statement and the SEP were hawkish, so we'll put a little H there, but that actual little change was dovish, potentially putting in question this just shows you that they have no freaking idea. That's really the answer there. In the SEP, we saw a move up to 5.6 from 5.3. We vividly recall that upward revision to inflation projections, despite data coming in line with the Fed's March, was most perplexing. Right, I would agree with that. Moreover, the upward revision in the SEP was paired with inflation risks that are still weighted to the upside. Yeah, he said that like 30 times. In relation to our forecast, we think this sets up core inflation to fall faster than the Fed currently projects, which should offset the takeaways from a higher peak rate in the dot plot. By the September meeting, we believe core inflation projections for this year, as well as the level of the Fed funds rate, what? Just going to cut off like that? Oh, could get revised downward. Interesting. That's actually interesting. This is not the Mike Wilson Morgan Stanley camp. This is your other camp inside Morgan Stanley. And this is actually somewhat of a bullish and dovish statement, if anything. Powell attempted to strike a balance between the FOMC statement and showed a more flexible data-dependent consensus. Nearly all committee participants expect that it will be appropriate to raise rates somewhat further by the end of the year, and the July FOMC meeting will be live. He also underscored the dot plot shows no cuts expected until 2024. I think, as anyone can see, not a single person on the committee wrote down a rate cut, nor do I think it's at all appropriate. At the same time, there were more dovish comments emphasizing that these SEP projections are not a committee decision or plan. The committee made this decision today only about this meeting. We did not make a decision going forward. It's true, some more distancing there. Pause sets a higher bar for a follow-up hike. There's only one more jobs and CPI data print between June and July. Not enough data to paint a different picture of the economy. We preliminarily expect June payrolls to be over 200K, but paired with moderation in core CPI. Let's see, falling for a third straight month. Powell emphasized the need to see more data. We think that puts them more on pace for a September hike. See, I agree with that. I would lean towards September as well, just to get enough data. Buying time, basically, right? Yeah. All right. So that's Morgan Stanley's take. In the latest outlook, we continue to see a soft landing for the economy and wages slowly easing, as well as job gains consistent with economic outlook. We expect the Fed to hold the peak rate at 5.1 for an extended period before making the first 25 basis point cut in March of 2024. Okay, then let's take a moment and jump on over to what JPM says, and then we'll have seen Morgan Stanley, Goldman, and JPM. I prepared JPMs for us here. This is the one they're kicking the door in again. Oh, these headlines. All right. Here comes JPM. Here's the JPM report. JPM, the outcome of today's FOMC meeting was hawkish and peculiar. While the committee unanimously voted to leave rates unchanged, a large majority of the FOMC participants anticipated at least 2 more rate hikes this year, and only 2 see the current setting as appropriate. So why not hike today? Powell said it was a continuation of slowing down the hikes. He tried not to tip his hand on July, but given how many on his committee are inclined to hike multiple times this year, it may be hard to get them to pause for more than one meeting. As such, we now look for 1 more hike in July. We continue to believe the lagged effects of rate hikes will weigh further on growth, and don't believe the median 2 forecast will be needed. So nobody's really agreeing that the 2 forecast is the right way to go. Since the decision to hold rates today was well signaled, the real news was the dots, particularly the dots suggesting the potential for going up to 5.625. Given these projections, a recurring issue in the press conference was pausing when 12 of 18 participants see at least 2 more rate hikes in the last half of the year, and 4 indicating 1 more. One can speculate that a deal was struck between hawks and doves to pause, but strongly signal a future hike. See, I agree with that. In fact, that's what Nick T suggested as well, that there was some kind of deal that we're going to pause in June, and then they purposefully went hot to try to paper signal another hike. That's possible. Normally, the post-meeting statement isn't a detail, but edits to today's statement were minor and reflect policy on hold rather than tightening. Trust forecast of disinflation, but rather need to see it happen, right? Not trusting the forecast. Right. Powell did mention the forecast had been wrong before. Yeah, that's JPM. Okay, so JPM sees July, Morgan Stanley September. Goldman seems to agree as well with July, and really seems like what you got is most people projecting at least one more hike. I personally don't buy it because of the soft data, but I suppose we'll see what happens over the next few days in data. We'll or a few weeks here, and we'll see what happens next month. But boy, I think a lot of people were looking for clarity from this last meeting. We did not get clarity from this last meeting. We got more confusion. So I think with that ends today's Meet Kevin Report number 106. I'm going to go to the course member live stream about 10 minutes early today just because I've got a flight to catch. So I've got to go a little bit early.